because I'm hearing your news right now.
You got it on the Weather Channel.
Yeah, she must. Well, like I said, some people are coming in through workplace, and so the one that come through workplace are the one that's. We'll mute them though.
Yep. So right now I should have just kind of the three of us that are on here right now, or Bill. So today, well, let's just go ahead and get started. So this is Alan and Ming Richardson. So thank y'all very much for joining us today. We have some special guests with us here for our sales meeting today. We got Bill Miller, the attorney from Burgess Title and Miller Law. We have David Karamitro, the big shot with Homeowners Financial Group kind of thing. And so they're both going to be speaking to us today a lot about what's kind of going on in the market. And so we're going to let Bill, I'm going to let you kind of jump in there and kind of give us what is closings like? Because we're hearing on one hand that we can now do virtual closings, but then the lenders and the people who are actually funding the loan, it doesn't work exactly that way. So Bill, if you would just kind of give us a download of what is a closing these days looking like, and are they still happening?
Yeah, absolutely. Thanks for letting me be a part of this morning. Yes, the closings are still happening. They are different than what you're probably used to. There's a couple things I want to go through. One is the video conferencing closings, the remote closings. That was just passed or allowed. And so that's kind of the buzzword, and everybody's calling us about that. A couple things with that. One, the lender has to approve that, which is, which was just one part of it. But logistically on these closings, we have to get a package to a borrower. We have to get that package back from the borrower. We have to get funding from the lender. And so it is an option. There are many other options as well. And so, what we like to do is to discuss all of the options with the borrower. Everyone has a different comfort level as to how they social distance and how they approach this. And so, we have, for example, in our office, we have a conference room downstairs that is completely separate from our lobby and our main office. We have folks that go into that conference room. We could video conference from upstairs to downstairs. We could then fund everything at the same time. As a general rule right now, we have buyers in one room, sellers in another room. We only have folks who are signing and their agents or loan officers in the closing if they come. I'm finding that a lot of agents are not coming to closing if they've got a client who's fairly well versed in this process. We don't have more than a couple people in our lobby. We'll have folks wait in the car. We'll call them when it's time for them to come up. But as an agent, you're going to get a buyer who says, "How are we doing this process? Can we do a video conference?" And what I would just ask is that let us talk to that buyer. Let us go through the different options and give them a comfort level. We've got a closing next week. The lady is pregnant. She's what I would think would be very, very cautious. She is. Her husband's coming in to sign downstairs. He's going to be by himself in a conference room. The doors will be open. He won't touch anything. He's then going to take the documents to his wife, who will be in the car, and sign those documents. I'll be 6 feet away outside, and if they have any questions, I can certainly answer that. He'll bring the documents back to us, and then we'll fund everything. So every scenario, every situation is a little different. But the simple answer is, can we do video conferencing for closings? Yes. Is that the best scenario? Probably not always, but it is certainly an option to do that. So the same as with the remote notaries. That was passed along with the video conferencing, so that we're allowed, when an individual is in Georgia, because we are Georgia notaries, that we're allowed to get their ID, watch them sign those documents, and notarize those documents via a video connection, which is something we couldn't do before either. So, from a seller's perspective, it's a little easier to get stuff done remotely. It's fewer documents. You're not having to have a lender's package and everything that comes with that. So from a seller standpoint, pretty easy for us to send stuff to a seller and have all of those documents signed remotely and then FedEx back to us, and then be able to fund on the day that the closing takes place. But from a buyer's perspective, it's a little more of a challenge sometimes. But again, we would ask that you give us a chance to talk with your client, and let's come up with the best solution to get everything funded, closed in a timely manner. So.
Okay, so you do allow notary and mail away package at this point?
Yeah, absolutely. So another thing that we're doing, we're waiving any of the fees for a power of attorney. So, again, there's different options for the agents that are not comfortable coming to a closing. We will wire if you have a DA. We will wire to you and waive the wire fee. We're all trying to make it as easy as possible, as safe as possible. And so if waiving those fees helps that process and gives you a comfort level or gives your client a better comfort level, we are happy to do that. And so those are the other two things as well. But it really goes back to, call us, talk to us, and let us give you some solutions to make your customer feel safe and comfortable in getting this thing closed the best way possible. And that's all we really want to do. So,
because the loan still won't fund until we get a wet signature, correct? And that's kind of been one of the.
That's right. And so some lenders require a funding number. We've got a FedEx, we have to email everything to get funding authorization. And so, there can be a delay in that process. If we have someone out of state and we have a lender that says that's fine, we're going to do a mail away ahead of time. It's going to close on a Friday, but we're having the borrower sign documents on a Thursday, and the lender says, hey, that's fine. They can sign documents on Thursday. We can close on Friday. We're going to have a package to you on Wednesday. You can FedEx it Thursday. They sign Thursday. They FedEx it back Friday. That's the perfect scenario. Everybody's on the same page. The lender approves it. We get a package early, and everything works as it should. And so that's a great way to do it. It doesn't always work that way. And so that's the other thing, but there's absolutely, and that's why we talk about power of attorneys. The lender has to approve the power of attorney for a buyer. But we would certainly prepare that and get that to them as well. If we have a closing next week, and the person who's going to be power of attorney is another attorney who's up on the north side of town, and we're going to get documents to him to sign and get those back. So, again, it's almost every situation we look at it individually and determine what's the best way to make that happen as quickly as possible. So,
are you seeing any other consistent issues or anything that we need to be leery of or conscious of?
Or advice for an agent?
Yeah, contract issues. Is there anything that's new that we need to be like, hey, watch out for this, that kind of thing?
Yeah, no, good question. I really haven't. I look at our pipeline of titles that come in. I talk to agents that when we're in closings. It still seems that there's a good bit of activity. It almost seems like folks that have stuff in the pipeline are pushing to get it through because they want that they don't know what 2 weeks holds, and they want to go ahead and get that wrapped up. I did see we did have one closing where it was a jumbo loan, and the program changed, and the loan to value went from a 90% to an 80% loan to value. In that situation, the buyer and seller did a lease purchase for 6 months. The buyer put a portion of that down payment as down towards the lease purchase, and they just kind of worked out what I thought was a very good situation. And did a 6-month lease purchase, thinking that underwriting would change maybe and the climate would change in 6 months. Right. But I don't recall. I know it was a jumbo loan, and it was about a week and a half ago that happened. So that's the only thing I've seen. And again, I'm not the one to talk from the lender's perspective on that, but just from our end of it, that's the only thing I have seen lender wise that was a little different than what we would normally see.
Right.
Right.
Okay. Well, I know y'all that Bill does a really great job and he's always about paying you guys immediately. And our brokerage will waive the requirement of the you being present for DA. So if you want your funds wired to your account, that's fine for the time being. As long as that there's no changes on your as far as the closing date or the expiration or the amount. Because if the amount changes, I can't do anything for you without a revised DA, and no attorney would release any fund without that revised DA. And the attorney is more than welcome to wire the funding to us just so you can get your money quicker instead of waiting for U.S. Postal Services. Okay.
Last thing, Bill, is this adding any extra time onto the closing processes? I mean, I know that, like,
It is. Well, it's
even doing title searches is a little bit more of a
Oh,
job for
yeah.
you guys right now.
Yeah. So good. Another good question. We some of the courthouses it just depends on the county. Some of the counties you have to make an appointment to get into the courthouse to run those titles. Some of them it really varies by courthouses is how we do that. From a closing standpoint, with a buyer in one room, with a seller in another. Christine's another attorney with us, and we usually split the closings. And so I'm in one room and she's in another, and we're trying to just get folks in and out of our office as quickly as possible. And so we kind of tag team it, for lack of a better word, with buyers and sellers in order to get everybody. We don't double book anymore. We kind of limit. We were trying to limit everything.
Yeah.
Trying to limit everything to keep the the grouping of 10 or less, and trying to follow those guidelines. And so that's really what we're working to do. But it is certainly a different time, but we're making the best of it, and we're keeping the wheel turning, and hopefully everyone sees the results of that with their closings and everything else. So
Absolutely.
Great.
Okay.
All right. Well, Bill, thank you
Thank
very
you so
much.
much.
We really appreciate you being with us. You're welcome to hang out, kind of thing. But
no, absolutely.
we know
Absolutely.
you guys have a lot of stuff going on as well. So thank you for your time.
We appreciate
Absolutely.
it.
Thank you very much. Appreciate the opportunity.
All right. Thank you.
Bye-bye.
Bye now. All right. Next up, we have David Karamitro, and David Karamitro is he's our buddy for a long time now, and he is well, David, why don't you tell us your role and kind of what's going on in your world, also, and then we'd love to hear what's going on in lending, because
Yes.
for us, we see that lending is kind of like the gatekeeper right now. Lending is changing almost daily. And so would love to kind of.
Why don't you take it over, David?
Yeah.
I got it. So good morning. Thank you guys for having me. Yeah, times have changed a little bit, and all of us want to believe, and I think that's going to be the case, is everything's going to be short term. I don't think all of what we're going to kind of get or how we're getting impacted will be short term, but the majority of it will be. Again, my name is David Karamitro. I am the area manager for Homeowners Financial Group. I run the states of Alabama, Georgia, and South Carolina for my organization. Been partners with Ming and Alan for quite some time. So again, very appreciative to be on the call. I'll kind of piggyback on Bill, and Bill did a great job there on his side of things. What's funny is our industry continues to kind of be discombobulated. We're not connected with one another. So while Bill and the attorneys can do what's called RON, which is remote online notarization, the back end of our equation, remember, we're the stepchild stuck in the middle as the lender. The back end of our process, which is the agencies and the end investors, they have not adopted RON. So while the governor has put that in as a kind of a state of emergency act to kind of keep real estate transactions moving, the agencies have not accepted it. So if we go and proceed as a lender to do it, and when I say the agencies, to make sure everybody understands, Fannie Mae, Freddie Mac, Ginnie Mae, those guys that are on the very, very top end of the food chain, they're saying, hey guys, we haven't accepted it. It needs time to be vetted through. So while it's an option on one side, it's not an option on the other side. So Typically what we're seeing a lot of these days is really mailaways. That's how everybody's kind of treating it. I loved Bill's, it sounded more like a divorce than it did a purchase, but that they were walking outside to the car. He was 6 feet from the car. The husband was delivering the paperwork. Neat, creative. And I can appreciate, Bill, that's very nice of them and conducive to kind of what's going on to want to waive their power of attorney fees. It's small things that are making a difference. So before I go any further, any questions kind of on that piece?
No, not on the whole back end. I think we're all very much interested on kind of what your crystal ball says, kind of moving forward. You know, we keep seeing unemployment issues. At the same time, we see people are being way more thrifty, way more savvy, for lack of a better term. There's people are being pretty smart about this. You know, our kind of general take is that this is everything is related to COVID, and when COVID goes, everything else kind of starts easing back into the realm of normal. I think there's going to be a transition for that for sure. And so what that means as far as, what do we, like we're just seeing rates kind of all over the place. We're seeing FHA nearly gone, or if it is there, it's pretty much higher rates. All our DPA programs are basically gone unless you're going to do
VA or
5 or 6. I mean, we had one contract come in with a 7.5% rate.
That was crazy
on it. So, I just kind of would love a bit of a, what your grist ball says and what you're looking at.
Take a shot at it.
Yeah.
Because no one really knows really right now, but through experience, what we're all kind of going back in time in our worlds and kind of creating a situation that we can compare to is really for 2007, 2008, when things kind of fell apart with the Great Recession. So yes, DPA and things, those are going to be the most challenged. Well, let me take a step back. Everything is a byproduct of risk. So today, what we're seeing happening is because there's heightened risk in the market. The way that the lenders, and not lenders, again, we're the middleman in the transaction, really the money folks on the back end are dictating what they want, and we execute on that. So what they're seeing right now, and the reason why there aren't any heads up, typically if a product is going to change from what Bill said on a jumbo, right? If it was 90% on a jumbo LTV and it was going to go 80%, they'd give you 30 days, 60 days, and they'd say, hey guys, listen, this is kind of going to go away for a little bit, but we're going to give you 60 days to lock in anything you got. Right now, the way to kind of give an example of what's going on is the house is exploding and we're asking for a heads up. It's impossible. If the house is exploded, there's no heads up to it. It just happened. So that's what's happening in the marketplace is lenders are coming out, the end investors are coming out and going, hey, we used to go down to 80%, we're going down to 90 now. And the real reason behind it is, again, risk. And when we talk about risk is the folks that are buying the paper in the secondary market, all the mortgages that we create, they're seeing, especially on the low end, folks that may be on an FHA or VA or USDA, and that's why you're seeing most of the changes there. There are folks that have 1 month in reserves. They're not your conventional buyer that's going to have 6 months in reserves, to where we haven't seen much of anything happen today in conventional yet. I think it's coming, but we haven't yet. I think where we've seen it is FHA, USDA, VA, because again, the profile of the customer, lower credit scores, less reserves. What happens there is they're the ones that are likely, they have all good intent, but they're the ones likely to default. When a default happens, well, the paper goes bad. No investor in the back end market right now wants that paper because of that risk. Ming, you may look like you may have a question, or I may be interpreting wrong.
I was trying to see on Workplace real quick. I apologize.
No, you're good. And I didn't mean to put you on the spot. I didn't know if you had a question.
No, I guess, your suggestions to my agent right now is to ensure that they keep in touch almost on an every other day basis to see where the market is moving. Well, almost. I mean, is your firm currently adopting a policy where anything changes, automatic emails being sent out to the agents that you are working with, and just
That's
kind
right.
of give us an idea, because we talked a couple of weeks ago before this ever came about, and we actually told our agent, go ahead, get your client, lock down the rates, get everything done, because come tomorrow that might be a different scenario, which it did. I mean,
Well, and we've heard different things about Locke because, and I'm not speaking of Homeowners Financial Group, but we've had some that were quote unquote locked, and now those locks don't count. Now, my understanding at the moment is that in order to have a true lock, you have to have a property associated with
correct.
it.
100%.
So,
100%.
Even though you may have, your client may have been quote unquote locked in the past, just means that they locked their rate. That doesn't mean that their loan is locked in unless they have a mortgage. Is that really what the case is for a lock, or how does that go if you do have a mortgage or a rate that is locked?
So that's very true. Without a property, you're not going to get a rate lock these days, period. Now, I like to say that I'm speaking for 100%. I don't know that I know 100% of the lenders out there, but I could probably tell you it's 99%. So without a property, you're not going to be able to lock. Even with a lock, I've heard of nightmare stories over the last 30 days of people at the closing table.
Oh yeah.
And lenders kind of pulling back and going, sorry guys, my end investor came to us this morning and they will not take these anymore, so we cannot take yours. The solution for many out there right now, or not many, for a handful, they believe is servicing. And they go, hey, listen, I don't have to sell it. I don't have to sell the paper to anybody. I'll just keep it and service it until times get better, and then I'll sell it. The challenge with that is when you're servicing a loan, you are also on the hook for the payment to the end investor as a servicer. So if the buyer goes bad or the borrower goes bad on a loan, given the circumstances and they can't help it, the servicer owes that payment to the end investor. Now, mind you, if 30 or 40% of that portfolio goes bad, there isn't a lender in the United States, forget our size, and we're a $2 billion plus company, but even the Bank of Americas and the Wells Fargos, they don't have that kind of money stashed away to be able to make those payments if a mass amount of folks are forced to miss payments. So that's where that risk is, and it could take you underwater overnight. So if you choose to go service, which some are right now going, listen, I think we got a little cash reserves we're going to service. If things go wrong on the payment front, that group of folks are in trouble, big trouble.
Oh, wow.
Well, I mean, we saw that I think it was just yesterday that Chase released that their minimum credit score is 700 with 20% down. And,
I believe it.
That just seems a bit,
drastic.
a bit, more than drastic, a bit of a knee-jerk reaction kind of thing.
So,
well, before you jump in, we are seeing a decline right now, but it's all tied to COVID. What we're not seeing, like you said earlier, we're not seeing the market on fire. We're not seeing transactions have stopped and that everything is dead. We're not really looking at 08 overall as a brokerage kind of thing at all. And so it's one of those where I don't want to scare the daylights out of everybody, but I do want to be very realistic about it as well, because we're still doing transactions. We're still and we're building a lot of relationships right now. And so I don't want it to be that the whole world is on fire and all this is coming crashing down, because we're still doing a lot of really good things. And the market is, I'm sorry, I just kicked her. The whole market is not gone away. And so I didn't mean to cut you off there, but.
No, so what you're seeing from a Chase, to address them, and funny, you and I were talking about it right when we were about to kick off the call. The big boys in the market, the Chase, the Wells, the Bank of America, when we say big boys from a money and size perspective, they can't opt to not lend because if they do, they get a lot of pressure from the U.S. government. So when you're seeing somebody coming forth and going, hey, we're just doing 720% down, really what they're looking at you guys and going is, we're not lending. It's their own cute way of doing it, right? So to your point, when I went back to 07 and 08, it was just, we went back as lenders to see what it was like for a disruption in the market. The two do not compare. So I'm glad you brought that up. We only went back to see, all right, when there was a serious disruption in the market, what were the things that were happening? In 07 and 08, there was a fundamental situation that had occurred. that cause that. In this case, we don't have a fundamental, but the longer the economy stays locked down, the bigger the problem can become. So when we see our president, I won't go political on this, but when we see our president go, hey, we need to unlock the economy, part of that is the pressure of, if we don't, this is going to get worse. So the fear there is health versus economy, and you can go back and forth on that. But having said that, at the end of the day, every lender out there has a different taste for what they feel like risk is right now. You will find lenders that will do as low as 620 on FHA today. You will also find lenders that will go up to 700. 700 is a stretch. 680 I've seen quite a bit on FHA, which again, if you think about it, 680, that's not even the FHA profile. FHA profile is 660 and below.
Right. And so if you're going to be a 680 FHA, you're basically saying we don't want to do FHA.
Fair.
Yeah. Yeah.
So the 660, that's where we lie today, is 660. There's conversation with the home office that's a call I'm going to be jumping on here shortly with them. I've taken it down to 640. It's really all right now about common sense underwriting. Guys, deals are being done everywhere. Is it at the volume that we left off before COVID hit? No, of course not. But it is not shut down. The market is not shut down. People are purchasing. Rates are all over the board. Now, what I heard from over the weekend, some reading that I've done, is that Jeannie Mae, who is FHA, has been the first to step up and create a liquidity fix. And they're saying they're going to, which is basically the government, is going to infuse some money into the situation to free up liquidity. Well, once they do that, now they didn't put a timeline to it, but I got to believe it's got to be pretty quick. Once they do that, rates on FHA will settle down. And when they settle down, they'll also probably bottom out at some point. But settling down will pull you at a rate of about anywhere from 3.875 to 3.625 to 4%, somewhere around there. When they bottom out, it'll be below 3%, maybe even high 2%.
Wow.
But you will get to a point of things kind of getting to a place of calm and ease to whatever degree. I think that's coming for FHA from a rate perspective. I think once rates happen, what's going to happen on the back end is they're going to want to purchase that paper a little bit more. If they purchase that paper a little bit more, then you'll see a relaxation of overlays. Right now, you've seen, to use Alan's term, a knee-jerk reaction, because nobody knows how anybody's reacting to the situation. So it's like, well, I don't want to get stuck with a bunch of low credit score paper that I can't sell that can really sink me to the bottom of the ocean. So I'm just going to not do it. Once they start infusing that liquidity into that portion of the market, they start purchasing on the back end. What more than anything you're going to see is you're not going to see the 580 manual underwrites. That's going to kind of go away for a little bit.
Mm-hmm.
But you will see the make sense 622, 624 FHA deal. And you will see all those coming back. Where you'll also have a challenge, you won't have a challenge in Georgia Dream. Georgia Dream will come back and that'll be fine. But any of the other stuff, like we were dabbling into 100% conventional product that we were putting out in the market, like literally a week before this hit. That's gone away. The end investor within a week of COVID came back and we're like, we're not interested. We're not doing it anytime soon. We'll get back to you. Those one-off down payment assistance programs may have a challenge. Georgia Dream will come back. And that's the general VA, of course, USDA, wherever applicable. But that's it in a nutshell. It's all risk related. It's a knee-jerk reaction. Y'all don't get caught in the knee-jerk reactions. Don't become a part of it. Be out in your marketplaces educating people for what you know. If you don't know the lending side, as I don't know the contractual real estate side, I go to my buddies, Ming and Alan, when I have a question for them to kind of give me direction. Y'all do the same. Know what you know, say what you know, but when you don't know something, go to your loan officer, come to myself, go to Alan and Ming. They know where to find me. And we can kind of give you direction on it, but be the calmness in there. Don't, oh yeah, I know the world's coming to an end. Don't feed into that because it only makes things worse out there.
Well, we're actually looking at housing being one of the things that really drives the economy out of this on the other end. I mean, when you look at, Americans have twice the savings that they had in 2008. inventory is still at 3 months of standing inventory. Yes, we have less buyers right now, but we also have less sellers. So it continues to be a seller's market. Mortgage rates, even through this whole thing, are ridiculously low, which makes affordability incredibly attractive to today's buyers. So this is not '08, and we really do see that housing is going to be one of those drivers for the economy out of this thing on the other end, and lending with it, kind of thing. And so, I just really appreciate your time here today, because we're not. I'm not trying to paint this everything is perfect kind of scenario, but I'm also not a doom and gloom. The world's coming to an end, and it's just going to be hellfire and brimstone going on, because that's not what we see in being completely realistic. I mean, on the lending side, what are your feelings as far as going ahead? How are you feeling? Like have you sold your house and are you ready to move? I mean, you changed an industry. Tell us what's going on.
I'm in the mountains.
Awesome.
So the truth is, to give you an example of what you were saying about the end of the world, I remember a friend of mine coming to me about 3 weeks ago and going, I need to get out. I need to go pull all my money out of the bank. And I'm like, hold on. Why are you going to pull your money out of your bank? He's like, well, if it all comes crashing down. I'm like, guys, your dollar won't be worth anything if it all comes crashing down. Please stop. Leave the money in the bank. It's all good. So here's what my take on it is. I think the first step is it comes from a health perspective. I think if we can find not necessarily a vaccine, because we realize a vaccine is 12 to 18 months out, but we can find something to treat it, and it opens up the doors again for everybody to be out. I think everything will slowly start getting back to normal. Like anything else, there's an overreaction to this. It's a big deal, no doubt about it. But going forward, once that opens up, I think we get back to a base of about 620 in the lending world as an average on FHA. I think VA and so forth are not going to be impacted. USDA, conventional, right now, conventional is the lowest product is 3%. I think if anything, it goes to, a 5% kind of situation. Jumbos come back. Don't know how relevant jumbo business is out there for who's doing what. But today you could do a conforming loan limit of up to $1 million in a purchase price, meaning you could do a first conforming at 540, whatever it is. And then you could do the second part of it at 10% down with just a second lien on it. So you have ways to circumvent the jumbo product. That's probably going to be impacted a little bit. But outside of that, I think we see this going into the summer a little bit tight. But from there on, just like economists are saying, once we get into the third and fourth quarter, things are going to start picking up. Everything is about consumer confidence. You are a part of consumer confidence. Make sure you're out there preaching that the end of the world is not coming to. We're fine. I'll be coming back down from the mountains, and we'll all be okay.
Great.
Nice beer.
Yeah. Well thanks. We like the Grizzly Adams look, so that's really good.
Mountain.
But thank y'all thank you, David. We appreciate your time, and thanks for joining us and giving us a little bit of insight in what's going on in the mortgage world. And just thank you very much. So.
And I'm jumping on another call, as I had said, but I'd love to give my number out to anybody on the call. If you guys found any of it interesting and you have more in-depth questions and you want to have a 15-minute conversation, my direct number is 404-513-4110. Again, 404-513-4110. This isn't about business, guys. It's about leaning on one another to get through this time, and the business will come.
Absolutely.
Awesome.
Thank you.
All right.
Appreciate you.
Thanks, David.
Good to see you guys.
All right.
All right.
You too now. All right. Well, that was great of David to join us. So we sure do appreciate him coming with us. And so we're going to kind of jump into where we wanted to start the day, just kind of going over what is it that's really going on. And so, right now, just it does kind of start off kind of here where, I love this little slide right here. Gen X's and millennials, the Zoomers, when the next recession hits, kind of thing, like first time, like this is all this is not that bad. And I know that it can be that way, but there's still a lot of really positive things going on in our market. Not everything is positive, and I'm not going to be one that says like, hey, everything is absolutely perfect. We did see the the issue with, JP Morgan Chase going up to a credit score of 700 with a 20% down. That's really, really true, but that just basically means they don't want a loan right now. And so, that doesn't mean that that's what's happening long-term in our industry right now.
And you'll see them coming down here shortly. Once the economy stabilizes a little bit, they'll drop that rules as well.
Yeah, absolutely. Also, we're going to be, at the same time, we're also creating this generation of super savers right now. Because on one hand, we do have high unemployment. Yeah.
My nail's not done.
So that's not all bad, see? Anyway, so on this graph right here, you can see all the areas where we are not spending as much right now. Of course, home improvement, video streaming, food delivery, online grocers, that kind of thing is up. But when you really look at overall spending right now as an industry kind of thing, you'll actually see that there is a massive change going on right now in credit and debit card spending. Health and beauty, restaurants, entertainment, transportation, shopping, travel, everything is down big kind of thing. And so on one hand, we do have high unemployment. We also have people that are being really, really smart and really, really thrifty about what's going on with how much money they have in their pocket, and kind of seeing that this is not a really long-term thing. One of the things that I like most when you look at this slide right here is when you look at what's happened with grocery spending. Everybody went out for the first week and a half, 2 weeks, and went absolutely nuts. And you couldn't get toilet paper along with all the other kind of stuff. And then if you look at where spending is now on groceries kind of thing, our McDonough office is in a Kroger shopping center. And there were days when you couldn't get in the entire shopping center. And today there's 10% of the car
lines lining up to our storefront. So 6 feet apart.
And so it's all starting to ease out, that kind of thing. But people are being smart about the money that they have coming in and the whole 9 yards on that side of things. We have to make sure that we look at this in a big picture scenario kind of thing. And so if you look at the S&P Case-Shiller U.S. National House Price Index, you can see where home price appreciation for the last 50 years, it has been averaging at about 5% on a very consistent basis. Now, you'll notice that on the blue line, that shows where actual house prices have actually moved. And the gray bars, these are all the different recessions that we've had over since 1975. These are all the different recessions that we've had. And so you can see that even during the 2000 recession, home prices really shot up kind of thing. Now, we knew in 08 and 09, that wasn't the case, but we all were Oprah Winfrey of real estate. Everybody, if you had a pulse, we were going to get you in a house kind of thing. And so it's not always bad news for that, but we have to make sure that we're explaining to our clients that overall housing continues for the last 50 plus years. It's averaged a 5% increase annually, or every single year over year kind of thing. We average about a 5% increase, and that continues to be the case. We're not looking at this market being one where just like it was in 08 and how that works out. The other thing is, if you look at the breakdown of labor statistics, now this is from the April 3rd unemployment report, and it doesn't have the entire month in there. But when you look at where folks are, or where the unemployment is coming from, nearly 60% is from food services and drinking places. Now that is massive. But the good part about that is, as soon as I can go have a drink, I'm gonna. So these places are gonna open back up, kind of thing. I'm not trying to promote alcoholism or anything like that, but I love, we love to eat out, and not that drive-through isn't great, but that's it's a small piece of that industry right there. So 60% of these folks go back to work really, really quickly. Mm-hmm. When you look at the breakdown of the other of here, construction workers. That right now we have less. We have a much greater demand than we have supply. So construction goes right back into work. Healthcare office workers, those folks, those are the folks that did mammograms and sonograms and that kind of stuff. These are folks that were in the medical field, but they were not
non-emergency.
Yeah, that kind of stuff. Child care workers, who here is not ready to send their kids back right now? I love my children, but I didn't sign up to be homeschooling, and so child care workers going right back on there. Temporary help services, the same kind of thing. Retail jumps right back in. The accommodation, everything jumps back in. We have about a 9.8% that's just kind of out there. A lot of that's made up with mining and things like that. And so, but overall, we're looking at even though unemployment is high right now, this is all unemployment that comes back. This is not of course, there's going to be a certain percentage of these jobs that just don't ever come back. But the large majority of these are coming back. Everything is tied to the recession right now. So what do we got to be doing? First of all, we got to make sure that we're focusing on our core competencies. We have to stay real with our data, but we also have to be positive and stay positive kind of thing. We truly should be focusing on our engagement, making a lot of phone calls, utilizing social media, texting, and emailing. These are the easiest things to do. None of these require face-to-face interactions kind of thing. And so we can all do this while social distancing, and we should be doing this. Most of your clients are sitting there with their thumb up their caboose. Okay. And so we want to make sure that now is the time for us to really focus on your top 20% of your customer base. Really engage those folks. When we see time and time again, it's that handful of referrers that sends you so much business. So really focus on that top 20%. Cut out the bottom 20%, the folks that just don't make any sense. Now's the time to truly engage and focus on the folk, your business kind of thing. You have the time to do it. We need to stop sitting on the couch eating bonbons and filling our head with 24/7 news. I know I've never had a bonbon. I haven't had bonbon in years, but you know what I'm saying.
You're dating yourself.
Okay, that's true. One interesting statistic that I found last week was that all website traffic is dominated by non-brokers nationally. So Zillow, Realtor.com, Trulia, only Redfin makes the top 5 kind of thing. And then you have Coldwell Banker, Remax. And so one thing I'm going to encourage all of you to do is to look at being able to utilize your websites. What we find is that people don't generally search for us and don't search properties through our websites unless we send them there. Because if we send them to the websites, then they use that. If we send them, and you can, if you have your Georgia MLS website, it does the same kind of thing. Anytime that you send them to a website, that's the one they're going to use. And I would much rather they were on my website searching and looking at data. And when an agent's name pops up, it's got me on it. And so we should really be doing to me, this one shows that there's an incredible opportunity for us to truly engage with folks and to be the resource and take this away from folks like Zillow. One other thing we need to be looking at is we need to be trying to improve our operating processes and look at how can we deliver a better customer experience. So first up, we need to be keeping a schedule, and that's a tall order right now for a lot of real estate agents. They're like, what day is it? It's this day, that day, and then the day after that day, and the other day. It's kind of like we all moved to Vegas, and there's no clocks on the wall. No one knows what time it is, what it looks like outside kind of thing. So having a schedule where you actually go to work but by going to work, you also have to define what does going to work look like for me. How many phone calls into your database are you going to make? How many emails are you going to send? What does that look like? And actually define what going into work looks like. A lot of us has CRMs, a client relationship manager, a database. Now's the time to clean that up. Now's the time to really engage in your database and truly try, tweak it, build, all that time that we said, one day I'm going to fix my CRM. One day I'm going to clean up my database. Well, guess what? That day's today. You need to be jumping in there and getting that thing done. The other thing is looking at defining what our buyer and seller sales processes are. as real estate agents, we tend to be gunslingers, you know, pew, pew. You know, that's just kind of our thing. So we get a buyer, we wing it. We get a seller, we wing it. Well, instead of winging it, really define, you know, how do you take a buyer through the entire buyer process? First time first time I greet them, and I get to know them a bit. Then I send them my lender. Then I set up I input them into my CRM. But whatever your process is, now's the time to define what that is. Because once you define what your buyer and your seller sales process is, you can replicate that very, very easily. And then every time that you have a buyer and you know where you're at with them, you know what the next step is because you have already created a process. Now is the time to truly look to deliver on that. So,
not only that, when you have a process, the consumer confidence is much higher, and most likely you will get the referral because, like they'll tell. I have heard lots of compliment from our past clients that doesn't work with me, but with our agent. They will call me once in a while and say, "I just want you to know, so and so did such a great job. I felt like I knew the whole entire process." And that definitely, matter of fact, I have one that was supposedly a referral from Motovo. But what happened was,
Movoto.
yeah, Movoto.
Close.
Anyways, what happened was they promised, well, basically, they kind of stepped in. They did nothing on the referral and did nothing for the lady when she sold the house. She's like, you know what? I don't want my kickback, which was only like $1,000 from them. And she's like, I want my agent to get the whole entire commission because the referral company was trying to step in and said, hey, we referred her. And when I talked to the client and my agent, the client said they never referred me. I knew that this agent for a long time. And so anyway, I was able to get that waived. Um, our agent got the whole 3% commission on a $300,000 home. So not having split at 30%, it's a huge blessing. So, but anyway, if you would just get your system streamlined, I promise you that people will come back time after time. If not, be one of your biggest cheerleader.
Yep. The other thing that we need to do right now is also protect our cash flow.
So, part of your strategy for the year, you should have a budget on what you're going to spend and what your marketing dollars are. And granted, nobody expected COVID-19, but rather routing your budget to a certain thing that's currently not working, let's work on the social media bit of it because everybody is online. And so spend a little bit of money on online, promote yourself. And and also what I find, and one of my agent tells me, she said, I go to Dollar Store and get those little, 10 cards, thank you cards for $1. And I will send a $5 gift card from Starbucks or something like that, or something, maybe Kroger, say, here's for a gallon bleach, whatever, how you want to your message send. But to where the client thought, hey, this is pretty cool,
Well, and honestly, it's a lot more about actually sending a handwritten thank you
Oh,
letter
yeah.
or card more than anything. When I get a handwritten note, it's not about the gift card in there. It's the fact that someone actually took the time to write me a handwritten note. That's a big
Well, not
deal.
only that, even $5 is not a whole lot, but the fact that you're able to give them some ideas, put some thought in their head. So, anyways, just know where you want to spend your budget. Review your credit options. Look at what you got coming in debt, and also what you have for income. And if you're able to pay off your credit card, do that. You guys do know the rule of thumb is never to charge up more than 30% what your credit limit is to have a great credit. If you charge more than 50%, I can tell you right now, you're on the teetering edge. More than 50%, you're going to have a negative credit report, just so you know, even though you pay on time. It's just the way credit services rate you. All right.
You also want to try and build as much a reserve, and it's one of those things, like a lot of times we can see who had the closing by who comes in with a new car kind of thing. And then rather than doing that, it's about being wise about it. So if you can pay off your credit card with your next closing, pay that off, because now you have options, you have the opportunity. And for the folks that just make that minimum payment and then go out and, hey, it's big screen TV time because I'm sitting around the house and I got nothing better to do. And then a closing gets delayed. Now you're struggling, kind of thing. So when you can, look at paying off those credit cards in full when you have a closing.
And right now is not a time to be frivolous at home. Y'all, please work on your CRM, your touches, talk to your client. If you already had a budget for a certain thing at home, yes. If you have some downtime, do it. Okay. But if that wasn't part of your budget, don't do it because you probably need to save your pennies right now. And some people ask, is forbearance an option for you? Let me caution you on that because
Big time.
Alan and I have been doing a lot of study on what's going on in the current matter. The forbearance, they tell you is 6 months deferred. Okay. What they don't tell you is at the end of 6 months, the entire sum is due. So don't think that you are able to push off for 6 months not paying and that there's no consequences. These 6 months do not get added to the back end of your loan. Okay.
In most cases. Now there are a few instances where they are doing that, but you need to
Not a whole lot.
Not very many. You need to be reading your loan documents and as well as instructing your clients to do the same thing, because we're seeing some people that are taking a 90, 180 day deferment. And then
Right.
at the end of that time, the bank's saying, okay, if you had $1,000 a month and well, now it's month 7, they're like, okay, now I need $7,000. You're like, oh, I thought this was at the end. No.
And that's not the case, y'all. So have your client, and I understand some people have no choice by doing that and hoping that once COVID-19 pass over, that they can pick up some side jobs and stuff like that. I mean, that's good and dandy, but make sure that they understand there's consequences. Okay.
Well, and it's going to be on a case by case basis. Do I know that every bank is going to hold up to that? I can tell you that this is what the loan documents say now, and we've seen time and time again. It's what everybody has agreed to, and I mean that loan document is a contract. This is what you've agreed to.
A contract, y'all. So y'all know that we deal with it every day. So next is unemployment.
Well, actually, we're kind of gonna jump ahead on unemployment here because
I'll touch that in just a few minutes.
Yeah, we'll be there, but we just want you to be smart. Because do we have another month or two where we're going through this? We do.
Absolutely.
Things are going to start ramping up. But once things start ramping up, we know that we're 60 and 90 days from a closing. Things are getting drug out right now. So we just need to be very smart and protect our cash flow whenever we can. Let's talk about what some of the options are, because there's a lot of stuff going on out there in the world. We're hearing about PPP and EIDL and the unemployment, the whole 9 yards. We wanted to share with you now. We want it known that we are not attorneys. We are not financial planners. We are not bankers. We're just going to try and offer you the best advice and what we've learned in going through this process, because some of these programs and options
may be available to you.
Yeah. And so Ming has done most of this. So I'm going to let her talk about it, but I just want to throw out there that understand that we're not trying to take the place of anybody. So
the PPP is all stand for Paycheck Protection Program. And what it is actually, it just opened up this past Friday for 1099s, independent contractors. What it is, they're based on your last year gross income divided by 12, and that give you an average monthly salary. You take that times 2.5. That is the potential loan you can apply for. The difference about and uniqueness about PPP is that it is forgivable. Okay. Once again, talk to your tax professional and also have a very good detailed P&L. If you can't provide the P&L, you might be ending up paying for it at the end of turn. I believe the PPP, don't quote me on it, it's deferred for 6 months. Okay. At the end of 6 months, if you can't justify where that money is going based on their guideline, then you may have to pay them back. And I know the interest rate on that is super, super low. It's less than 1.
3.5, I believe.
No, that's
Oh.
for EIDL. The
Okay.
PPP is actually less than 1%, but you do have to pay them back if you cannot justify where you're spending your paycheck protection plan for. The caveat on this one too, the reason why 2.5% is that they're allowing some utility as part of the paycheck protection program. If you need information on that, please go to SBA.gov and you'll see a lot of guideline on that. So typically that is processed through your local bank. Okay, so you will need to go whoever you deal with banking wise to get that processed. The EIDL, Economic Injury Disaster Loan, that is a true loan. Okay, you can apply for a $10,000 advance, no question asked. And that particular loan is up to $200,000 non-secure loan. And it has to be paid back, I believe, after 2 years. Now, they may change the guideline because originally it came out 10 years and they changed their timeline again. So go to sba.gov to get your detailed information. This is also not a forgivable loan, but like any government loans, there is criteria. But because the interest rate is so low on this and non-secure loan, you can't get that anywhere else. So if the bank is going to look at your P&L to, one, ensure you're a good borrower. If your P&L looks like you're losing money every year, you probably will not get the loan, just so you know. But anyways, I just want to touch on these two items.
Well, EIDL, you apply for that directly on the SBA.gov website.
Correct.
It's like 3 pages. It takes, if you have all your
the 10,000
Yeah.
is the 10,000 advance is 3 pages.
Yeah.
But once it gets your application, don't be surprised if you're asking more than $10,000 that they're gonna ask for additional information from
to
you.
justify
Right.
why you need more than 10.
Right. And it's got to be, and y'all, that's economic injury disaster loan. It is designed to help business that has suffered due to economic crisis.
And you don't work for your broker. You are a small business yourself.
Correct.
So as a small business, you qualify for the EIDL as well as for the PPP. If you don't want to go those routes, then unemployment is still an option. Right now, unemployment in the state of Georgia, you can go to dol.georgia.gov/PUA, and that stands for the Pandemic Unemployment Assistance Program. And that is now open for independent contractors. So if you didn't want to go those other options, you can, as an independent contractor, apply for unemployment. I believe it's somewhere around the $800-900 a week range kind of thing. I think it's like $300 something from the state, and the $600 from the feds for the moment. And so that might be the right option. I'm we're not going to tell you which is the best one because everybody's situation is different. But what we did want is to be able to offer these opportunities about what is out there and make sure that you're aware of what's going on. Probably the best place for true, accurate information about these programs
is SBA.
Is SBA.
Yeah, there's a lot of wealth. Financial Guru was going to tell you a lot of things you can play with. Just remember, these programs designed for those particular situation scenario. If you go outside those situation scenario, you might be owing at the end of the term. And this is not a, get money in so I can get whatever you want. This is not it. This is strictly for what is intended purpose.
Yep.
Okay.
Very good. All right. Well, we that wraps up where we're at right now. We just wanted to tell you thank you very much. We really appreciate you.
Open the mic.
We are here if you need anything.
Okay.
And if you need us, please call, text, smoke signals. We're doing Zoom meetings with agents. We're doing the offices are still open, I would love for everyone to say a little prayer. Wordsworth was pretty sick yesterday, and he had a fever, so we don't know if he's got the funk that's going around. But we're praying for our buddy Wordsworth at this moment, kind
Or
of
if
thing.
it's not an allergy or hay fever.
Well, hopefully that's what it is. So we should know a little bit better today. But please, everyone stay safe. Everyone be smart. We are going to get through this, and we're right here with you. So we love you. We appreciate you. And if there's anything we can do to help, please let us know.
Have a
Thank
great
y'all.
day. Thank you.